Okay, I'm now recording. This is our second lecture. I'll start the screen share again. Okay. I will post up also my answers for those couple of questions on that little quiz and everything. You should get your grades in soon. But I just wanted to jump in and start talking about the markets themselves for futures. So I'm going to go through this, and then I'm going to talk a little bit about how the videos are being posted on YouTube, where you can find them. And then I'm going to show you the textbook. I'm almost done. I'll show you where the state of it right now, and then we'll go from there. So as I go through this, if you have any questions, please let me know, because this is obviously, you know, your opportunity to get clarification if something I say isn't completely clear. This is just some things about the futures contracts. The big thing to understand is that futures are designed to be a standard contract. And so, you know, we're going to say you're going to deliver 100 ounces of gold on this date, you know, at this location. Normally there's a location specified, depends on the commodity. So the reason we would call it West Texas Intermediate oil in particular is because that's where we would pick it up, is in West Texas. So normally they'll tell you where exactly you can deliver it. I know with coffee futures, you can deliver those into New York or London. So they can be multiple locations, although they will price it differently because of the cost of transportation between those two locations. But what exactly they can give you will be specified. And so normally with things like oil, you know, that we'll contract it in like West Texas Intermediate, but if you want to deliver Brent, or if you need to deliver like a sour crude or something, then we have an exchange rate built in that we'll talk about that. But since they are standard contracts, we're able to trade them on an exchange because your contract is the same as mine. But for that to be true, all contracts have to settle daily. And that means at the end of the day, either you're going to pay some money or you're going to receive some money, or the price closed exactly how it opened. So if it opened at 1401 and then it closes at 1401, then there's no transfer of funds. But any other price, there would be a transfer of funds from one direction to the other, depending on if the price went up or if the price went down. So we do have to settle these futures daily, but that's what gives you that flexibility to then sell it immediately because it's already been settled. And so you can just come in and out, which is what we need for an exchange to work. So this part is, this gets confused a lot of times with a normal futures versus inverted futures. So what this is getting into is this convergence of the future to the spot price, right? And so you should see up there, there's two types, A and B. Where the futures price is more than the spot price. Now, when the futures contract is up, they need to converge. They must converge. I should say they must come together. But if the futures price is above the spot price, we say that is contango. So if you think about what this means, so this would be like today, and this is in 6 months, right? And so what we're saying is basically the short term is less than what the long term is presumed to be, right? So if you have something like I used oil as an example before, right? So oil, we normally think of it this way because it's non-perishable, right? So if you have things that'll go bad, like orange juice, that's another commodity that we trade. If it's perishable, then it'll behave slightly differently. But oil, I can let that sit in a tanker for a year and there's no problem with it. But there is going to be a cost of carry, right? So that means I'm paying for transportation, I'm paying for storage. I have an opportunity cost, right? Because my money is tied up in this oil itself. And so I have to, beat what I would have been able to get in the market. I could have invested into treasuries or something like that and got a rate of return. So, and so I have all of those things sort of combined, right? To say that, that me having it right now is not as valuable as it would be in the future, because I have to pay for transportation. I've got to pay for storage, until that delivery. And so since I have all those costs sort of baked in, the spot price will be less than that futures price, right? And again, contango, and I can't tell you the origin of that, like why it's contango, but CONTANGO, contango. If it's steep, and we saw this happen when COVID started shutting down economies, right? Or economies were being shut down while COVID was going on. You have this oversupply, right? And you, at the same time, you have this decrease in demand. So if you have either one of those things happen, some sort of oversupply or some sort of drop off in demand, then that contango difference actually gets worse, right? Because you end up with all this supply and nobody's wanting to buy it. And so you're stuck trying to store it. And so the cost of storage will shoot up, that type of thing. So anytime you see steep contango, then what that's telling you is there's some sort of disruption in the market where you have either too much being produced or not enough being consumed, or some combination of both. So if you think about where we were a year ago, in March, we had a lot of production coming out of the Middle East. In fact, they were overproducing because they were trying to jam up a lot of Russian oil markets. So they were basically leasing tankers and parking them into ports that Russia normally delivers their crude. And they were, in effect, trying to break Russia's oil market. And so when all that was going on and then COVID hit, we had this oversupply, but then at the same time, people stopped driving, right? We stopped flying around. And so the demand for jet fuel, the demand for diesel, and the demand for gasoline, just petrol type fuels, all of those decreased. Right. So there's markets beyond that, like plastics, pharmaceuticals, all the petrochemical markets, so there's still demand, but it's not the type of demand that we have when we're, burning oil to fly from one place to another. And so because of that type of disruption, we saw oil become very steep in its contango. So that's that first one, the A. B, if you see the futures price is less than the spot price, they call that normal backwardation or just backwardation. It's backward, BACKWARD, Asian, backwardation, okay, ATION. So what this is basically there's increased demand right now. Right, people want it now, and so for the case of oil, if you had some sort of disruption to supply, let's just say, again, going back to example about a year and a half ago now, a little longer maybe, some folks from Yemen attacked Saudi Arabian oil production in what's known as the Ghawar field. So if you look at a map of Saudi Arabia, like right there in the middle of Saudi Arabia, basically. So it's north of what's called the empty quarter, where nothing is but desert. But it's south of Riyadh. That area is the Ghawar field, and they had an attack on that production facility, and it literally brought more oil offline than the Allied bombing campaigns during World War II. Right. If you look at all the bombing campaigns across Europe and Asia, when the Allies were shutting down oil going to Germany or Japan. This was a bigger disruption, right? And so anytime you get some sort of shock like that, where supply gets constrained, because obviously they didn't shut down everything. I mean, the United States produces more oil than Saudi Arabia, or at least did then. Actually, I think they do even today, even with our recent disruption. But anytime you have that type of constraint in your supply, or if you were to have like global demand growth, and so the last time we really started having global demand growth, it was really about 10 years ago. We've been in a bit of a slump globally for a while. I know in the United States, you saw a turnaround. But if you think about what was going on in like Asian markets and things like that, but if you go back to say 2008, when China was building up, for the Olympics, and then they started building all those, the ghost cities now, they were building all these huge cities. There was this huge growth, and you started seeing backwardation. So even though I just said oil markets, you expect it to be contango, that's this when it flipped to backwardation. Normal backwardation, and the reason for that flip was there was this global growth in demand. So if you had your hedging portfolio built because normal oil, and then everything flips, you can see how your hedge could be working against what your purposes are. And so that's why it's really important as we're going to go forward for you to understand that we have storage costs and all this stuff going on in our contango. But if we were to flip to this normal backwardation, because of that flip, now suddenly people are going to want to try to close out their storage, right? We're going to try to, because that spot price is so much more than what that future price is going to be, right? And so we're going to see all this oil come back onto the market, or whatever, the commodity was. So, but yeah, so I wanted to make sure that was clear, because I'm going to talk a little bit about normal futures curves and inverted futures curves. And that's really more about the shape of this right here, not is the future above the spot or is the future below the spot. So that's why there's going to be two different things. And sometimes people get them confused and they start thinking, oh, well, this is normal or this is normal. And it's like, no, don't think of it that way. This is all about is spot below the future or a spot above the future. Right. So, so I just wanted to go over that. Another thing we need to talk about is margin. And you may have heard the term margin call. If you've already taken investments, then you've probably encountered margin that way. But what margin is basically you have something put up as collateral. And then based on that, you're able to affect trades. So when we teach this in investments, it's normally because you're taking things like short positions, and that type of thing. But with a futures contract, we have to have margin because we're going to settle this every day, and we need to know that the money's going to be there for you to settle it, right? So, and so if you look here at the margin. You can think of this as, okay, I'm going to open up my brokerage account. I'm going to put, say, $5,000 in, and then that $5,000 is going to be held in this account. And so as long as I'm able to stay above the maintenance margin requirement, that's when you would get a margin call, then I can affect trades. And so the balance is adjusted daily. Remember, like I said, every day we're going to move money from one side to the other, the short to the long or the long to the short. And so we have place because we are trading this daily, and we need to make sure that we're able to settle it at the end of the day. If we need to close out a position, we can. And so when you get the margin call, you don't bring it back up to the maintenance margin requirement. You actually have to bring it all the way up to what the initial margin requirement is. And I believe I have an example. So yeah, okay. And so we're going to take this position. There's two contracts, right? And the futures price is $1,250 each. So for two contracts, that's $2,500. Now the initial margin requirement is going to be $6,000 per contract. So if I have 2 contracts, that's $12,000, and the maintenance margin is $4,500 per contract, or 9,000 total, and the contracts are 100 ounces each. So this is an example. So if you think on day 1, right, we're going to go in and the price is at $1,250 per contract. Okay. And I am required to deposit $12,000. So if you see here on this first day, that was that initial, but then that day closed, right? I entered in at some like noon maybe, right? And when that market closed, then the price had fallen from $1,250 to $1,241. It lost $9 per contract. Okay, does that make sense? And this is quoted in ounces, right? Dollars per ounce, right? So, so the $9 times 200 ounces total is $1,800. And so they took $1,800 from my margin account, right? So it drops down to 10,200. That's how much is remaining, right? And the second day, it drops a little bit further. And so more money gets paid out. And then we show here all the way to day 7, right? And now it has moved, $4,000 below where it was initially, 4,020, below where it was initially. And so now I have gone below the $9,000, $9,000 maintenance requirement, right? So all these, I was losing money, but I was staying above $9,000, right? But once it hit $9,000, I get that margin call, right? And we call it that because literally your broker is going to give you a phone call and say, hey, this just happened. We need you to make this right. Right. And if you say, oh, I don't have it, that's fine. We're just going to close your account out. Right. We're going to get the money either way, because we still have the 7,000 here. You're just not going to be open in this position. We're going to take part of this money to offset. We get into how we close these out, but they'll just close it out because they're not going to let you keep an open account when that position is moving against you if you don't go and pay. And so for those of you that maybe are paying attention to the Reddit Wall Street bets and the positions that they were taking with GameStop's stock price, the GME. It was a little bit different because this is futures, but it was similar because it was on margin. You had a lot of people that sold GameStop, and so when GameStop shot up in price, all of this was working against them, right? And so they were all getting their margin calls. And it was like about $5 billion, I think was what they were needing to come up with. So, so everybody gets margin calls. If you ever watch the movie Trading Places with Eddie Murphy and Dan Aykroyd, there's a big scene with they're doing a lot of futures trades at the end. And basically they're told at the end, these two large traders, you need to settle this. It's going to be however many millions it was. And they were like, we don't have this in cash. I mean, there's no way for us to. And then they were like, okay, well, let's just go and auction off their seats. We're going to, because they were like, we're going to get the money out of you either way. Right. And so that's how this will work. And so we got that margin call and we paid. And then the next day the price went up. So if we could have just waited a day, we wouldn't have had to pay. Right. But we're not able to wait that day. Right. So the price goes up and now we're up above the margin of 12,000 that was required to begin with. And then by day 16, the price has moved the way we want it to. And so we end up, it's gone. Let's see. So we made our gain. And so we're able to close out our account. So not that it would always do this. It's just kind of try to show you how that margin call works, right? And so the big things are, remember, we settle this daily. So your money is going to transfer at the end of the day. Now to close out that position, what they do is they take an offsetting position. So if you're long on gold, they'll just short gold, and then those two contracts cancel each other out, and those other parties can deal with their own margins, right? And I think I told you guys that when I was doing this with international paper, it was to offset transportation costs, and I was using fuel futures. I didn't want to take delivery of fuel, right? Because it's not my railroad. I'm just contracting with railroads. You know, it's not my trucking company. I just would call up, you know, JB Hunt or Swift or whatever the transportation company was. Um, so I wanted to close that out before maturity, and most contracts are going to close before maturity, right? The people that want delivery are people that are not using this as a hedge normally as much as it's some sort of input. You know, so if you think of General Mills, they probably want corn delivered. They want rice delivered, right? Because they're going to turn that into breakfast cereals and that kind of thing. So they actually need the wheat. But a lot of other people, they don't necessarily need the wheat. They just use that to offset, you know, some input price or something else. So most of the contracts will never have delivery. And so when you're thinking about maybe doing futures tradings on your own, you don't have to worry about somebody suddenly delivering, you know, 50 sides of beef to your house or something, because you can always close these out before the delivery date. Okay. So I'm gonna show you like the exchange clearinghouse type of stuff. The big thing to understand with this is we used to only do sort of these bilateral agreements, you know, where we would, you know, at the end of the day, we would pay money to each other, but there was no central person overseeing all of this. We were pretty much expected to keep our own houses in order, as it were. But there's been a push to move more and more things to various clearing houses. And the idea behind that is we saw during the 2008, 2009 financial crisis, that there were just a lot of contracts that we didn't understand, you know, the volume and who the concentration within certain industries and things like that. And so just for regulators to have a better handle on things, the idea was let's move more things to clearinghouses. That way we are able to see more clearly how big these markets are and where they may be starting to concentrate. So as we go through this, let's just to show you the cash flows first. I'll show that. So when the future price increases, if you're short, you know, you've taken a negative position, it's moved against you. And so the money moves from the short trader all the way up through the clearinghouse and then back down through the members of the house to whichever broker you're working with. And your broker could be a member, but oftentimes they're not. I mean, they don't bother to. If you're using a retail brokerage, dealing mostly in equities and maybe a few debt instruments like bonds, they don't necessarily stay in the futures markets. You know, this isn't an area they would operate in, but they could go to a clearinghouse member that could process this for them, of course, for a fee, right? But yeah, so the short trader, they take it from their margin account. The brokerage house pushes it on through. It goes to the brokerage house of the person that's long, and they'll see that show up within their margin account. Okay. If the futures price were to decrease, then it just goes the other way. So this was the example where gold, we went in when it was 1,250. As that price was falling, more and more money was taken from that margin account, and then it would be pushed through the clearinghouse and then back down to that, whoever is on the short side, they're going to see it build up within their account. So again, this is just how that money moves. Like I said, used to be, we did a lot of bilateral clearing. The idea was just, you know, we can handle most of our own trades. You know, we don't want to pay for the fees of having someone else handle this for us, especially if we're doing a lot of trades, if we're very, very active. It could get not expensive is the right word, but it will just eat away at what your returns are, right? And so normally we wanted to have bilateral clearing, but like I said, there's just been a lot of push to move from this bilateral clearing to getting more and more standardized with our contracts, to include when we say OTC, it's over the counter. So these are going to be things that they're not standard. So we have to make some small changes. But the push has been for us to move away from making those changes and to find ways internally to make those work for ourselves, but they're not, you can still do over the counter trades. And often when you're doing that, it really is because both parties have an underlying need to have something that's just a little bit different. So we have that. Let's see. But yeah, and so the central clearing parties, if you just notice the nature of it, we can just observe a lot more of these transactions because otherwise we wouldn't have any insight into the transaction. It's just two companies that are contracted with each other, right? So it's just like a contract for a company to have cleaning services, you know, housekeeping and that kind of thing taken care of elsewhere, and they just have a contract, and then there's payments that are made. That's how these are. It's just there's a contract and payments are made. And I'm sorry, go ahead. Did you have a question?
I do not.
Oh, okay. All right. Okay. So let me, okay. Just a couple of things for you to know as we go through this. When they talk about open interest, that's how many contracts are out. And so that gives you an idea of the depth of that market, right? And if you see spikes in open interest or collapses in open interest, that's just a thing to look into, you know, to try to get a sense of what may be going on. The settlement price is that final price. And so they use whatever the price, the last one that cleared when they cut it off, right? That's the settlement price. And so there's been trades going on all day, and the prices could have been bouncing up and down or just doing whatever. But there will be a final price, and we'll just say, okay, and we'll settle it at this price, and then we make the margin adjustments as we need to, right, from one account to the other. Okay. This is to show you how these prices are. So we always talk about what the open and then the close, you know, how that will be. The prior settlement, that was closing the previous day. So we'll have these after hours trades that'll occur. And this is where people basically are saying, hey, as soon as it opens, I'm going to need to buy some, or I need to sell some. And so you can see when it opened a bit higher. So there was obviously increased demand overnight. In fact, that's what you'll hear it referred to as, is like the overnights, you know, came in this way. The high and the low, this is where we'll make our candlesticks. And so you'll see a lot of times on these trays, these little bars that, you know, they stack up beside each other. And then you'll see we call them candlesticks because there's like a little wick that'll come off and they can go up or down or both. And so we'll have the open and then the close, and then the high and low are represented through that wick. And the low or high could be equal to the open or equal to the close. And that just means it, you know, it was going up and then we closed it, or it was going down and we closed it, you know, so it's not a big deal if that happens. So just so you understand what these numbers are saying. And then the volume is just to give you a sense of how deep the trades were in that particular market. So this is in May. So the next month out, you see a huge amount of volume. That's why oftentimes you try to close it about a month early, because once you start getting really close to your settlement, things just start getting a little more volatile, right? Because people are really concerned, because this is where like oil refineries have to really start getting their delivery, right? And so when you start thinking about what that means, right? Like, okay, we're going to have to really try to settle up all of these oil contracts. You know, people start jumping in and out of the market. Some speculators start seeing movement and they'll get really excited. Every time there's something on the news, you know, they say, hey, there was an attack on a oil transport ship as it was traveling through the Straits of Malacca, you know, or something like that. Suddenly that'll, you know, spook markets or something like that. Or you'll hear, you know, that Gazprom, which is the oil and gas company owned by the Russian government, because they've got nationalized there, but they've got some new gas discovery or oil discovery, and then prices will just suddenly collapse because everybody's curious to see how quickly they can get this to market. So you'll normally try to close this a month before or so, but you do want your futures date to be close to when you are would want to make your purchase. So with a hedge, what we do oftentimes is called stack and roll, where we'll have just a bunch of them through various, like September, December, March, and then June. We'll just have a whole bunch of them, like I said, stacked up. And then when one of them starts to get to that point where it's starting to get volatile, we just go ahead and close that one out and get another one a year later. And that's why we call it stack and roll, because we stack them up and then we just roll it down to that next one. And we just keep doing that year over year. And that's a way for us to keep this rolling hedge against what our future energy prices would be, or whatever it is we're trying to offset. If we were a food company, so like Smithfield is a large pork producer. Pork bellies, are traded in these markets, and about half of all the pork produced in the United States currently goes to China, right? There's about 4 times as many Chinese folks as there are American folks. China has more people in the middle class than there are Americans, right? So they're definitely eating a whole lot of hogs, and so all of those markets going there. If you think about it from a soybean producer, maybe monitoring that, you would want to offset some of your costs because you're going to be supplying based on what future pork prices are, because soy is used to feed those pigs at these commercial feedlots. So and so that sort of stack and roll is used across commodities, right? Just got to put that out there. If it's not closed out before maturity, then you can have delivery. Whoever is short, that's the person that's going to be making the delivery, right? Because they got into that position. They'll if there's options available, they're the ones that can exercise those options. So they can say, look, I know we wanted West Texas Intermediate. I've got Brent that's actually lighter and a bit sweeter. So it's better for the refineries, because you don't have all the sulfur and things like that to bring out. And so because it's easier to crack or whatever, then you're going to give me a better deal than what we contracted, because I get to deliver this better one. Or if I had to take something like the crude, about the worst I've seen commercially available is the stuff out of Venezuela. That crude oil is about the color and consistency of peanut butter. So it's oil, but it's oil sort of like in a chemical sense, not what we normally think of as oil. That's what Venezuela pulls out of the ground. It's much like the oil sands of Canada. I don't know if you know about that. It's basically oil soaked in dirt. That's why it's oil sands, and we liberate that through steam. And what comes out is this thick stuff that you have to heat up a bit to even pump it, because it's just so thick. That's we call that heavy oil. And in fact, the tar or the oil sands, that's beyond heavy. So we have to heat it just to pump it. For those of you that are keeping up with the news, the the XL pipeline, Keystone XL, that's what it brings oil from Alberta and ties into the existing Keystone pipeline. Keystone goes from South Dakota all the way down to New Orleans. Well, I should just say the Gulf Coast, because it goes to refineries as far east as maybe Mobile, Alabama, maybe even to Pensacola. Although I don't know if there's any refineries left in Pensacola. I think they may have moved them all further west. But from there, and then all the way over in the west to Houston, Galveston, that area. And all of those refineries can handle the heavy stuff because that's where all the Venezuela crude would go, right? And so those refineries, they're about the only ones in the world that can handle that thick, nasty stuff. And so most of the other refineries, they're used to the light sweet crude like the Brent, and the Brent comes out of that Guar field in Saudi Arabia. So it's that really sweet oil. Sweet means low sulfur content, right? So it's just lots of hydrogens and carbons and not other stuff, right? Because it's a hydrocarbon. That's what we want. Short chain hydrogen carbons. Not yeah. So anyway, I know there's a bit of an aside, but that's why those types of things matter, because it's delivering commodities from one place to another, right? And so when you read about the Keystone XL pipeline, that's just because where are they going to get it refined? They're pretty much going to have to go to Louisiana, Mississippi, Alabama, or Texas. And so right now they're doing it by rail car and a bit by barges. But they would much rather use a pipeline because it's about 1/3 the price if we can just pump it through a tube. So that's where all that discussion around Keystone comes from. I can't really get into the climate change and all of those arguments. We're gonna, as long as we're burning oil, the cheapest way to move it is going to be pipelines. So that's why there's the push to build the pipeline. It's just a cheaper way to get this oil out of Canada instead of just using the trains that we're currently using, right? Because trains derail. They derail a lot more often than people realize, and they dump, all these trains worth of oil, let's see. Some contracts settle in cash, but those normally tend to be things that are in cash or cash equivalences. And so, yeah, there's that. Okay. Hey, so remember I told you, don't confuse the contango and normal backwardation with like normal markets and inverted markets. A normal market means we expect future prices to be going up over time. So it's not, is the future above the spot or is the future below the spot, but is the future price itself going up? If so, consider that to be normal, right? All markets normally go up, right? They don't go down. They can go down, of course, and we see that happen. But we always think of the expectation is that they're going to go up because we're going to grow as a society. We're going to develop new technologies. We're going to come up with new systems, and all these things are going to grow. The population's growing, all these things are growing over time. And so the normal thing is for us to see this type of growth, right? And so that's a normal market, right? We have expectations of more in the future, not less, okay? Sometimes though, we have these inverted markets, and that's where we're expecting there to be less in the future, not more. And if you think about the curves that I showed to show the contango and the normal backwardation, it did both. It went up and then it went down and then it went back up. And that can happen too. We just refer to that as being partly normal. So we can even talk about it within time frames. Like it looks normal for the next 3 months, and then it switches to inverted for another 3 months, and then it goes back to normal. So just keep in mind, a normal market and inverted market, that is different than contango versus normal backwardation. Okay. All right, this is some questions I'll probably just throw on the, like a little quiz. I do want to talk about the types of orders that exist. So not everybody in here had to take investments. That wasn't a prereq to this course, so you may not have seen this yet. So I just want to talk through these. So if you notice here, open order, right? That's just where we just put the order in, right? That's like your normal order. A limit order is when you put in your market order and then you say, but I want to pay this price, right? So you put a limit on that. Because you put a limit, it doesn't automatically fill, right? It may never fill. And in fact, that's sort of the difference between the market order and then the limit order, is whether or not you know it's going to happen. So if a limit order happens, you know what price it happened at. If a market order happens, you just know it happened. You don't know the price, but you know it definitely will happen because as soon as it goes in, it clears. Okay. Stop loss and stop limit orders. This is where I put an order in and say, okay, I know the price is here at $40. If it falls to 35, go ahead and sell it. Stop my loss at 35, right? And so if I hit that trigger, then it puts in this market order, right? A stop limit order, I could say, okay, put in the limit order, but put in the limit order of this much, right? And so once I hit that stop loss point, instead of it being a market order and it immediately clears, it's a limit order, so it may not clear and I may not stop my losses, right? So that's the danger of putting in that type of stop limit. Market if touched, this would be similar to that stop loss, but maybe I'm looking at it going up and I'm like, okay, hey, if it rises up to $40, go ahead and put it in a market order. And it may not clear until 42, or something if it's going up really fast. But I'm putting in, instead of putting in a limit order and saying buying it at 40, I'm saying just put it in as a market order once I hit 40, right? Discretionary, time of day. These are going to be things where I'm trying to be careful because I don't want it to happen around news, right? If I'm expecting maybe a crop report is going to come out at 9:30 in the morning and the market opens at 9, I might say, hey, we're not going to start trading until 10, and that type of thing. And then I talked a little bit about open. If you have a good till canceled, it'd be like this open order. The opposite of that is fill or kill. That's where if I say, okay, do this order, but if you can't do this order exactly as I say, just kill it. I want this or I want nothing. That's what fill or kill means. And so you'll see all of these sort of come through, but this is a way as we're building our portfolio within the market, so we can see what that looks like. Right. Futures are regulated, and anytime we're talking about regulation, you have to imagine the government wants to protect the weakest people, right? And so you have the most protection for yourself when you are completely ignorant, right? Because the government's going to really restrict what you're able to do, right? But as you're able to demonstrate more and more knowledge, the government lets you do more and more with the understanding that you're going to bear a lot of this risk. So the government's going to make sure that we don't have market manipulation, right? Because if you think about who's trading, this could be a farmer, and I'm growing wheat, out in Kansas, or maybe I'm growing corn up in Iowa, or I'm growing soybeans over in Ohio, but I'm growing something and I just need to settle a market. I just need to know I'm going to have someone that wants to buy, whatever it is that I'm producing. And so we're going to have things in place to make sure people aren't able to take advantage of those folks. But at the same time, they're going to allow, an investment, a hedge fund is going to be able to take, this large position with the understanding that, hey, it's on you. And if you screw up, you're going to have to pay for this, right? And so just keep that in mind as we talk about regulation. So a little bit about tax. I don't know how many of you guys are accounting majors or double majors in finance and accounting, but you have to think about how are the cash flows recognized, right? Because remember, we're settling this at the end of every day, right? Which means we're able to mark to market all of our holdings every day, right? And so we're going to treat this as if we're closing out a position every day and then it's reopening it, right? And so as we're going through here, if you're seen as someone that is hedging, there's a whole lot of tax court law around who's hedging versus who's speculating, but if you're holding it as a hedge position, you're able to defer the recognition of taxes on your profit or losses until you close out that position. Where if you're in a speculator market, like you're on you're short selling the GME right now with the Games Workshop, or not Games Workshop, but GameStop. Sorry, Games Workshop is a different gaming company. They produce little plastic figures. But yeah, so if you're speculating, you're going to have short-term capital gains that you're dealing with, you know, continuously. But if you are Southwest and you have a position to offset your fuel prices, then as your, you know, your positions are rolling off, that's when you're going to recognize that. So we're going to give you a favorable tax treatment if you're seen as hedging. And again, who counts as hedging? It's going to be someone that has an underlying interest, even if you're not holding it. Like if you're just going to receive it in the future, because you have this underlying interest in it, then you'll be treated as hedging by the tax code, right? And this is going to be generally true regardless of the country you're operating in. So if you think about, you know, the global firms, like I said, I worked at International Paper. You know, we had operations across the planet. You know, then every jurisdiction would have their own tax treatment. But this is one of those things that's just sort of part of the generally accepted accounting principles, or the GAAP. You know, we should try to most accurately reflect what the company is doing as they go through these. So, forwards are different than futures. Remember, we said futures are going to be standardized. We try to put this on an exchange. That's one reason why we standardize things. And we always close that out at the end of the day, right, with that transfer of margin account from the whoever lost money in their position to the people that gained money in their position. So we settle this out daily. With forwards, we don't. Forwards tend to be longer term. It tends to be more of an ongoing relationship. And so, for instance, at International Paper, we had a lot of forward contracts on currencies, right? Because we had euros, we had British pounds, we had dollars, and even our dollars. You know, there were Canadian, Australian dollars in there. We had, I think Brazil's like the real, the Thai had baht. So we would have all of these foreign currencies that we would be operating in, but we didn't want to be involved in currency speculation. So we were just trying to minimize the damage or benefit even to us. So we wanted it to be as stable as possible and make our money on the commodity itself, paper, you know. So let me show you some, without a slide on that, but yeah, so futures and forwards are going to be a bit different in how we treat that, because we don't settle, but we are putting up collateral with the forward. And as we go through these, you're going to see me use this type of graph a lot. So you can think of this is wherever we purchased this, whatever, you know, at. And then if the price goes down, then we start having this loss, and the losses are going up dollar for dollar. If the price goes up, right, then our profit goes up and we see dollar for dollar, right? This would be going long, so we buy it. This would be going short, we sold it. And so short goes the opposite direction. So there's a maximum cap. If you're short, that's the most money you can make, but your losses don't have that type of limit. Where if you're long, the worst you can do is lose all your money. But there's no limit to the upside, right? And so whether you're long or short is going to depend on what you need to build your portfolio. But this is going to be our initial, and then we're going to talk about modifying this as we're building hedges and that type of thing. Sorry, my slide was out of order. I thought this slide was going to be the other one. So we talk about futures contract. Again, exchange traded, it's standard. There tends to be a range of delivery dates that we'll have built in. We settle it daily, right? At the end of every day, we'll look at what that end price was, and then we transfer money from margin accounts to settle that. We usually do not take delivery because we don't want delivery. We normally are using this as a hedge or something like that. And there's virtually no credit risk. Technically, there is still credit risk. We've had banks fail, you know, and that kind of thing. But because we're on this exchange and we're using standard contracts and things like that, it's going to eliminate a lot of that risk that we have from our counterparty. Where we're forwards, it's not going to be exchange traded. It's going to be two companies that have offsetting positions that they need to take. They tend to be non-standard because we're trying to fit those particular needs that we have. And since it's, you and I getting into this contract and we're going to make it exactly what we want, we don't build a lot of options because we don't need to, right? Where we're very clear up front on what exactly we want. And then we normally go all the way to the end of the contract. We can have a lot more of these contracts. We just, again, stack those. How I talked about the stack and roll with futures contracts. You can have multiple forwards and at different expirations, but often what we do is we just build the contract, for our particular need. When you're looking at exchange rates, normally they're going to tell you what the foreign currency is going to be in US dollars, right? And so we would say like 132 for a euro, so it'd be $1.32 to get 1 euro, is often how we do it. But with things like, you see, I've got listed there the like the Japanese yen. A Japanese yen is about a penny. And so, we would say like 122 yen to a dollar, so if the currency that we're dealing with is really small relative to a dollar, then we'll say, okay, $1 gets you this much. But for most other currencies, we quote it how many dollars it takes to get that unit of a foreign currency. All right, so I'll stop sharing that. I do want to show you this real quick though, just to kind of let you know what's going on. Let me go show my screen one more time. So I just haven't finished this yet, unfortunately. So this is the book I'm gonna give you. I just have to type it. Unfortunately, what's taking me a while are actually the formulas. Let me get down here to some of the formulas. But even these, it just takes a while, to put these in Word. I'm sure there's a faster way of doing these things, but I've got the text itself ready to go. But I'm still working on getting all these formulas because I know this stuff can be hard to understand without being able to read it. And if my formulas look janky, then it might be difficult for you to kind of understand, how these things are going to work. So I hope to have this done really soon. In the meantime, I'm just going to obviously have the videos and everything, but that way you guys will have a text. But it's a free textbook. Hopefully that's of some benefit to you. But yeah, so basically it's going to be a textbook that you guys will have as like a PDF, and then you can, refer to that. So like I said, the formulas, it's just really tedious. I have to go through and do all my superscripts and subscripts and all of that stuff in Word. And but as soon as I have all that done, I'll post that up. And then, like I said, you guys will have a copy of that to use, for going forward, right? You can, hopefully this will be a pretty good resource if you need to look back at it later. It'll have all the stuff you need. So like I said, I've got all of the text written. I just don't have all the formulas in yet. I'm about, let's see. So my text is about 100 pages right now, and I'm up to about page 50. So I'm about halfway done with formulas. And so as soon as I get all those done, like I said, I'll post that up for you. So just a quick reminder too, don't forget, I'm going to post up the solution, I guess you'd say, to the quiz I gave you. And I'll put up another little question just to have you guys be able to touch bases again with it. I'll also put up a link to this video, and then I'll put up a link to the playlist, right? So I'm putting this on YouTube. This is the first time I've done these. So I've created a page for it, and then I'm making a playlist, and all the lectures will be in order, and that way you guys can go through and watch that playlist, you know, and make sure you're all caught up. So are there any questions about anything today?
I don't have any.
Okay.
I
Well,
don't have any.
all right. Would you guys, do you want me to go ahead and plan to do this again, say maybe Thursday at 11, and go into a bit more detail around like the hedging strategies and that type of thing? We'll do some more, have just a bit more of a discussion about what we actually do when we're building a hedge. Does that sound good for everybody?
Sounds good to me.
Okay, great. Then I'll send out an example or another little meeting invite for Thursday. As soon as this video renders, and then I'll put it on YouTube. But both of those processes take just a little bit of time, so it won't be immediate. But I'll start this as soon as we get done now. And so you should see that probably this afternoon, the video to this lecture. So if you go back and rewatch this and you have any questions, by all means, shoot me an email. And then on Thursday, when we start talking about the hedging strategies and stuff, I'll start by answering any questions that you have, at least any ones that won't be answered through the hedging. Some of those things I'll probably bring up, and I'll just say, and we'll talk about this in about half an hour, you know, because I'll have a slide for it or something. So, but by all means, please, you know, go watch the videos and let me know any questions that you have, because the more interactive this can be, the easier it's going to be for you guys to understand it. So if there are no questions, though, I'll let you guys go. I'm going to stop recording now.